Hey, I'm Gene Goldman, and today is Monday, December 26th. Here's a look at the week ahead. Well, first and foremost, I hope you had a wonderful holiday and you spent some time with family, friends, and loved ones. As we look to next year, the biggest question we get from a lot of you, given the fact that the stock market performed so poorly this year, is how will it perform next year? Well, we don't have a crystal ball, but instead we can lay out our playbook for 2023. And in summary, it's this: near-term pain followed by long-term gain. So we do expect weakness in the stock market for the first part of next year, but then better performance in the second part. We do expect a ton of market volatility throughout the year as investors watch how high the Fed raises rates. Does it create a possible recession? And what will the impact be on corporate earnings? So why weak in the first part of next year? Why will the stock market be weak? Well, first of all, valuations in the stock market are above average, so they're not really reflecting high interest rates and high inflation that we see today. Second of all, corporate earnings likely need to be revised lower. So if you look at FactSet for 2023, FactSet expects the companies in the S&P 500 to earn 5% year over year. This is only down marginally from the high that was set back in June. Profit margins for companies are under pressure given high wage costs, higher borrowing costs, and here's the kicker: lower inflation. Inflation is starting to roll over, but this also reduces top-line growth for companies. Again, margins will be impacted. The third point is that the markets have priced in a mild recession. But what happens if that recession is worse? What happens if the markets need to re-gauge themselves? So first part of the year, we do expect it to be a little weak. Second half of the year, why do we expect a better performing stock market? Well, first of all, the Fed, in our opinion, should win the inflation battle. This will lead the Fed, in our opinion, to pause rate hikes. Second of all, as we noted in our 2023 market outlook, lowered expectations should be easier to beat in terms of the economy, in terms of corporate earnings. Third of all, historically, markets price in events about 12 months in advance. Eventually, the markets are going to start to price in an economic recovery from the expected recession that's anticipated for next year. Overall takeaway, markets are going to be volatile for a very, very long time. Thank you for listening. For more information, please follow us on Twitter at CeteraIM, and see you next week.